Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Now, anything can happen at any point in time. And you'll see a lot of activity. Those are the trades that I'm proud of. Hello, my name is Brian Overby. I am the Senior Options Analyst at Ally Invest. We're traveling today, but we're still going to persevere through the biggest earnings week of the quarter. We've had a lot of disappointing earnings. We've had a couple of good notes. Recently, General Electric came out, who has been truly beaten up, not only because of what's going on in the economy, but just the company in general. And so it was good to see them. They're up about 7% today on their earnings, and it has a little bit to do with that industry. Their aerospace industry has done fairly well. So that's one of the bright spots of the marketplace right now. And today we're going to actually talk about protection, though, because of everything that is going on with the earnings. We've saw Walmart come out and give very bad guidance. I guess bad or not good, to try to put a little bit more of a positive spin on it. And so their stock is down, brought down a lot of the retailers. Target is down. We're talking about Amazon this week. They're going to be announcing earnings on Thursday, so the speculation is, are they insulated, or are they going to have a lot of the same issues that Walmart was talking about, as far as the consumer is still spending, they're just not spending on big ticket items. They're being more cautious. They are spending the approximate same amount, but it's mainly because of inflation, the fact that food costs have gone up so much. So they're not really seeing a drop off in the spending. They're just not focusing, the consumer's just not focusing on big ticket items. So what a better opportunity to go on out and look at some protective strategies and options. That's what options were derived for to start with, buying options as protection. They weren't designed for pure speculation, even though some people will use them that way. So we're going to pretend today that we own 100 shares of Amazon, and we're going to look at how might I protect Amazon going into earnings, a known event where implied volatilities are going to be very high. So we're going to explore that trade, but before we get there, we'll talk a little bit about the markets, and we're going to look at last week's trade in Twitter. We did kind of definitely a speculative paper trade last week in Twitter. We looked at buying a long straddle, and it should have worked out for you. It really depends on how quick you were on the trigger, but we'll take a peek at that and look at that chart and see what happened with Twitter going into their earnings report. Okay, so right now we see that the markets are down, that we've been down a couple of days now, and we got the S&P 500 index down 47, about 1.2%. We've seen the VIX spike up, but still, once again, the VIX just isn't having that. The VIX is the only thing in the marketplace that doesn't seem to be scared about what's going on, in my opinion. It's trading right around 25. It is up today, but not a huge spike up. Once again, we get some down days in the marketplace, getting some bad news, but the VIX just isn't reacting, showing the true volatility of the marketplace. The actual vol, if you go back and do the math over the last month, has usually on most days been higher than what the VIX has implied. So I just find that interesting. We see the VVIX all the way down around 987. That is just set a new low. Now the VVIX is the VIX of the VIX. It tracks the implied volatility on the option contracts that trade in the VIX index. So the VVIX, usually if people are buying up VIX options for protection, in other words, they'd be buying calls because it has an inverse relationship to the marketplace, they're not willing to pay for them. They're paying the lowest prices for the VIX options since the pandemic. It's down in definitely the low end of the range. So the VIX is the one thing in the marketplace that just isn't showing, the fear index isn't showing a lot of fear as far as the market is concerned. I've always been saying this for a while. I really wish that we would get the big downturn in the SPX and just get it over with. Have a flushing out of the system and see the VIX have a big spike up above the 40, go towards the 45, 50 level, and would kind of give you maybe that was the bottom, because everybody's trying to figure out where the bottom is. Right now we have a lot of chop in the marketplace. Earnings are starting to come in poorly. Consumer spending, we have a little bit higher unemployment numbers, but bottom line is we just never had that defining moment of capitulation in the marketplace. So where do we go to next? Let's talk about Protect. Well, first of all, let's get into the Twitter trade from last week. We no longer do the stock play of the day overtime on Fridays, as you probably know. So we always review last week's trade. And I'm going to start by looking at the chart in Twitter. And I have a 15-minute chart. We had to tape Twitter a day early, or I'm sorry, we had to tape our show last week a day early. So Twitter was actually trading right around 38.35, and I'm highlighting that by the red line in the bottom of the bar. Now, we taped the show at the end of the day, but the market basically opened the very next day very close to where the stock was when we were setting up the paper trade. I don't know why I'm struggling with that so much, but so this is where the market was at, and we had a real strong move. Almost instantly, we ran all the way up to 40.50. And if you're buying premium, you'd like to have the move to happen fairly quick. And I did mention that if you're doing trades like a long straddle, where we bought the 38 call and bought the 38 put, it's okay to leg out of it. As a matter of fact, I prefer to leg out of it as to sell it as one trade. So if on one side of the trade, I can at least make what I paid for it, either from the call or from the long put, I'd be happy to do that. And especially if I could even make, let's say, 50 cents above and beyond the cost. The trade that we looked at, it was trading between 305 and 310. If we say it was 310, we should have been able, almost on the open the next day, when the stock was trading north of 40 for a good bit, it kind of hung up in the 39, 40 range. That means that we would have had at least $2 worth of intrinsic value. We still had high implied volatilities because the earnings announcement did not happen. If anything, implied volatility will usually continue to creep up going into earnings. And then we went all the way to the end of the week, and many times we were above 40. Here is, these are 15-minute bars. So this is all day Tuesday, all day Wednesday, all day Thursday, and then all day on Friday. So if we look at the different times going into that earnings report, we were up above 40, and there should have been an opportunity to sell out the call, make at least what we paid for on the trade, and then play the hope game on the downside and hope you get to downward movement on the put. It's a very news-based stock right now. Earnings came out, and they had very poor earnings, just like a lot of the other people in the advertising space so far, I should say. Snapchat was one of the biggest ones that really got beat up. And the stock really didn't move much. So it's really highlighting the fact that it's trading more so on the news with Elon Musk and the potential buyout as opposed to the actual earnings report. So it stayed stable after that. Some of the news that drove the stock higher was, I guess it was a win for Twitter, in that the judge came out and said that they want a quick trial, and the judge is also behind that thought and is promoting the fact that they want to fast track this trial. And that was really kind of I think that was the big jump up the very next day that caused it to go all the way up to 40.5. It didn't stay there long, but it did make that type of move. All right. Also on a long straddle, if I'm doing it, I want to have sell orders in. I don't mind having a sell order in on the call side or on the put side in case you do get that big move up. But my sell order would have been higher. We traded this for about $3.10. I would have a good till canceled sell order on the call side for about $5. And on the put side, I would have had a good till canceled order for about that same amount. I would just leave that in. Now, I would have deleted those going into the earnings report, because you don't know what's going to happen after the earnings, and you're going to have that big gap opening, or downside. This earnings report was, nothing happened. Real bad news, stock didn't move at all. So the news that's driving Twitter is obviously the Elon Musk story. Okay. So if I look at it now and you're not out of the trade, well, the stocks came all the way down to 39. So the trade's just not doing that well at this moment, but it's not down bad, considering that we already had an earnings announcement. So we did the July 29th expiration, and we bought the 38 strike put, and we bought the 38 strike call. So right now, they're both a little bit in the money. We paid around $3.10. So you're down about half. If you wrote it all the way through the earnings, you're down about half on that trade. So at this point, after we've had the news event, we only got a few more days until the 29th. I would look to get out of the trade. I would probably, you might be able to hang around on the put side, because the put's only trading for around 20 cents. But I would definitely sell the call. I would close out the trade, the side that had the most money, and then maybe play the hope game on the put side on that 38 strike. Never know when news is going to come out. Both the companies are in court battling in Delaware, so news could come out at any point in time. And that's when I like to consider long straddles, when the market can get blindsided by the news instead of having that known news event. This trade, if you would have been watching it and it was a speculative trade, you should have traded out of it on the upside, got a little bit of that benefit. But if you didn't, oh well, we're in this situation right now. Sell the call, remain long the put. That's simple. All right, so let's look at the stock that we're going to talk about today, which is Amazon. So let me pull up Amazon and see where we're at. We're down a lot of the market. Almost any retailer stock has been hurt by the Walmart news and the Walmart earnings. So we do see Amazon down 5%. We've recently gone through the stock split. So maybe there's some people that recently bought 100 shares of stock. It's part of the reason why I'm looking at Amazon today, because after the stock split, it made it more feasible to buy 100 shares. So we know they're going to have earnings. We know that so far a lot of the retailers have struggled with a lot of their earnings reports. How could we remain long Amazon going into their earnings by spending a little bit of money to try to protect ourselves? And some people may say, well, I don't need the protection now. The stock is already down, and that's all right. There's nothing wrong with that attitude. The biggest thing when I'm buying protection is I don't want to go out too far in time. If I'm still bullish on Amazon, I'm just going to try to find a range that will protect me going into the earnings report. I'm going to spend a little bit of money now. Now, I'm going to jump up and look at the options playbook, and the most common strategy is a protected put, where I buy the stock, which I'd already own, and I'm kind of saying that well, I guess I'm exploring this as you own 100 shares of Amazon. How can we protect it? And the bottom line, the simplest strategy is to just buy a put. Now that will protect you all the way down to zero, and I don't know if we need that much protection. It's going to be expensive, especially because of the volatility in the marketplace, not to mention the fact that we have this known event that's called earnings. So instead of buying just the put outright, what I would explore on any of the stocks, you have Google announcing tonight, you have Apple announcing. If you're nervous, maybe consider buying a long put spread as protection going into earnings. So I'm going to buy a put, and then I'm going to go and sell a put to help pay for the protection. So in this instance, on Amazon, we're going to be buying the basically the protective put, and then we're going to come out and say, well, I only want a little bit of protection. I'm going to go 10 points wide, and I'm going to protect myself for this range. But if it continues on down, I'm not willing to pay for that protection. I'm not as nervous that I feel like I need to just buy that put outright. So that strategy is actually a long put spread. And a lot of people think of long put spreads just speculating to the downside. What I'm saying here is that if you have 100 shares of stock, you could consider a long put spread by buying one put and selling another put to help finance your put that is going to do the lion's share of the work if we get a down move in Amazon after earnings. So let's run over to our stock chart. Let me find our chain once again. Okay, so here we go. So we have the chain in Amazon, and we're going to go, so they're going to be announcing earnings on the 29th. If you truly want to do just that earnings play, that's all right. Then they're going to announce on Thursday after the close. You have all day Friday. And if you're just worried about that initial gap down, if we get a gap down, then you could consider just doing the July 29th expiration. I'm going to give it a little bit more time. I'm going to look at the August 5th expiration, and we're going to look at what the expected move is on the stock just to try to give us a feel. And right now, this is the Amazon, this is that August expiration, which is 10 days away. We're buying the 115 call, which right here on the ask is 550. And then you're buying the 115 put. If we look at that long straddle, it's in saying by that expiration date, the expected move or potential move is right around $10. So that's how wide we're going to do our spread. The marketplace, if it goes more than $10, that means it went more than the expected move. That's basically the over. If it goes less than $10, then it went less than what the marketplace is implying, which is basically the under. Now, this isn't earnings. Remember, I'm going to emphasize there's 10 days remaining. So when you're looking at the options that expire on August 5th, that's the expected move going to August 5th by looking at that long straddle. Okay, so I'm going to clear that out, and we're going to stay in this expiration. Now, you can say to yourself, well, where would I be willing to take my deductible? And it looks like I got to add a couple more strikes to the downside here. How much risk would I be willing to take? Stock's at 115. Do I want to start by buying the $2 deductible, the 113 strike, or do I want the basically zero deductible, which would be right around 115? And if you think of your car insurance, how many people usually just buy the zero deductible car insurance? You usually don't, mainly because it's expensive. A lot of people don't want to pay for that. They're saying, I'll take on a little bit of risk. So we're going to do that too. We're going to buy the 113 and 3, 6, we still need some more. Okay. So if we buy the 113 strike, there are so many strikes because of the split, I apologize. That would be the put option that we're looking to buy. That's $375. So if we bought that outright, we'd have to pay $375 for that. And I think we're going to go down, let's go down to the 100 strike. So we'll go 103, that'll be 10. Okay, and then we're still getting $1 for it. I don't mind that at all. And now we've just reduced our costs. We went from $3.75 to buy that protection. We're going to be protected from 113 down to 103. That's the expected move. A little bit more because we got a little bit of a deductible on it. But we're insured basically on our 100 shares of stock from 113 all the way down to 103. And our total cost of that insurance would be $2.63 or $263. So this is one way that I can have that protection from 113 down to 103 going into earnings at a decent price. You're not going to get a great price because we got this known event. We're basically trying to, I mean, I guess this might be a little bit extreme, but trying to buy homeowners insurance on your house. If you're thinking of that, when there's a known storm / hurricane on its way, that's a little bit dramatic, but that hurricane would basically be the earnings that we're talking about on Amazon. So now, don't forget, we're assuming that since the split, you have bought Amazon because the stock split and now you can buy 100 shares of it. So some people were, cheering that, wanting that opportunity. We got a down day in the market because of a lot of the news. We're a little bit worried about their earnings. So we're going to buy a long put spread as protection. And by the way, while I'm setting this up, if you have any questions, please do put them in the chat box. Happy to address them today. We'll address them live right on the show. So if you can think of anything, you have any questions, any concerns, maybe you're looking at a different stock besides Amazon. And that's what the stock play of the day is all about. We're saying you can take these thoughts and these strategies and maybe apply them to your underlying stocks that you own. So in this instance, we're 262 on the mid. We got a fairly tight market, so we'll keep it right there. We're going 10 points wide, paying $262 to protect ourselves. We'll have protection from 113 down to 103, and we'll go out to that August 5th expiration about 10 days from now. All right. So that's in the right rail. That's the official paper trade. And then I'll highlight by looking at the profit and loss graph. We're going to zoom in a little bit. This is just showing you the long put spread. Wrong way. There we go. And it's showing this is where the stock is at. So from 113 all the way down to 103, this is the potential protection. And if you're buying this long put spread on your stock, you're still bullish on the market. You'd still be better off if the stock went up $10 as opposed to down $10, right? Because you own the stock, and that would offset the cost of the insurance. If you're doing this, you're still bullish on Amazon, but you're bullish but nervous. And so you're going to buy some protection as opposed to just selling Amazon outright, which a lot of people are doing today based off of the Walmart news, and it's driven the stock quite a bit lower. This is an interesting alternative. You're going to limit that risk to that net debit that you paid for it, $2.65. Now, you do have a deductible, right? Because stock's trading a little bit north of 115. So you got that $2 deductible. That would be a true cost. If you're looking at this position, that would be $2.65 plus $2. So we're looking at $4.65, which is a little less than what the stock is actually down today. But that would be your risk scenario. Now, obviously, if it goes below 103, well, your insurance doesn't help out anymore. You have traded off all that downside protection for getting a lower cost insurance policy that we will call our long put spread. All right, so if we have any questions, I'm going to check out the chat box right now. Okay, Clinton says he loves the hurricane. The hurricane was Walmart this time around. I think you emphasized that. Certainly was a bad earnings report to follow the hurricane. Okay, what impact will the FOC meeting have this week? Well, it's not out of the last time I checked the FedWatch tool that's put out by the CME, they did say there's still about a 20% chance of them going a full point. And that could definitely hurt things. If they don't do as expected and the Fed comes out with a 75 basis point hike, which that's what the market is anticipating right now, they're putting the probability based off of the price of the futures contract at around 80%. Now, I haven't checked those numbers before I got on the show today, but that's what they were yesterday. I think I checked them during the market. And, yeah, I think that would drive the market lower. The 1% rate, I don't think it's a bad move by the Fed to do it. Like I said, I'd like to have that capitulation market moment in the marketplace where we get the big downturn, the big spike up in the VIX, and you can say, well, maybe this is it. Let's start bottom fishing and maybe buy some indexes, maybe the NASDAQ, maybe the S&P. Just do some simple things in the marketplace, but we just don't have that defining moment. And if the Fed would just, rip the Band-Aid off and go that full point, I think it would maybe give us that opportunity. So I would be nervous. That's why we're talking about protective strategies today. And that's what the stock play of the day is all about. If you own 100 shares of Apple, 100 shares of Google, Google has now gone through the split. And since it's done that split, once again, there's probably a lot of people that came out and bought 100 shares just recently, just because they could. So that's where we're at. All right, any other questions that we have? If not, well, thank you for watching. It's going to be a real interesting week as far as option trading is concerned. I'm going to do a stock play of the day. This week on Options Playbook Radio, we'll look at a speculative trade in Amazon, probably look at some type of butterfly, because they do announce on a Thursday and you have 1 day for the option contracts to live. It's a very unique scenario in a volatile underlying. Yeah, Amazon always seems to announce on a Thursday after the close. So that always means you have an option contract that has 1 day to live, that basically all the time premium and all the implied volatility has to come out by the next day. So it makes it kind of fun to go out and look for interesting strategies. And you can check that out. Just go into wherever you like to listen to your podcasts and put in Options Playbook Radio. And I'll be taping that show on, actually I think I'm going to be doing it Thursday morning this week. If you'd like to learn about all of these events, please click subscribe, ring the bell, and you can also go to ally.com/investeducation, ally.com/investeducation, and you can sign up for our once-a-week email that tells you what's going on as far as the educational events inside Ally Invest. Thanks for coming, everyone, and we will see you this coming up Tuesday for the next stock play of the day. Thanks for coming, everyone.